Thanks for tuning in to today's podcast. Please remember that all of the information in this podcast episode is limited to general information only. That means the information is not specific to you, your needs, goals, or objectives. So you should seek the advice of a licensed and trusted financial professional before acting on the information. And before you acquire or apply for a financial product, please read the PDS or product disclosure statement, which should be available on the issuer's website. Lastly, please keep in mind that past performance is not indicative of future performance. In this episode of the Australian Investors Podcast, I'm chatting to Per Amundsen of ThinkTank Commercial Property Finance. ThinkTank is a relatively unique business because it serves both commercial property borrowers like SMSFs and it serves commercial property investors and those investors who want to get exposure to commercial property and the yield and I guess the lower volatility that comes with that, but they don't necessarily want to take the risk of a single property. ThinkTank presents this information in a really consumable way. Given that it's an asset class many investors do not have direct exposure to or typically rely on a third-party advice to get exposure to, I think this is a really good overview and, I guess, lay of the land of commercial property finance. If you like this episode and you want to hear more of this type of conversation, I'd love to know what you think, so send me a message. As always, I hope you enjoyed this episode of the Australian Investors Podcast. Per, thanks for joining me on the podcast.
You're very welcome. Nice to be with you.
One of the things I like to do is to hear a bit about your backstory. You've got a very, impressive backstory when it comes to banking, but then also now on the commercial property debt perspective, but commercial property more broadly as well. So why don't we go back, Per, and talk a bit about where your journey to finance and investing started? Was anyone in your family in investing or finance?
One part of the family was indeed, and that's how I ended up starting out in banking after taking a break from university before going back, and I was sort of directed to an uncle of mine who worked at a Canadian bank called the Toronto Dominion Bank. And he said, we can put you to work for a while. And sure enough, about, how many years, 18 years later, I ended up in Australia and had been working for TD, as they call it, in Canada. Mm-hmm. It's a bit ironic that today, while we're speaking, is the 1st of July, which is Canada Day. So there may be some relevance there too. But I ended up here in '87 after working various parts of the world with TD, and we opened up a corporate finance operation here, which was very exciting. And you might remember 1987. There were a few glitches in the stock market, kind of reminiscent of a few months ago, and so it was really quite fascinating. And I met my wife the first day I arrived, which was also quite kind of interesting. So that led to all sorts of things, and I ended up being recruited by Westpac to run some of their corporate banking divisions, and ended up spending the rest of my life here.
Yeah, right. So obviously, if we go back a little bit, you said you took a break from university. Was it a hard decision to end up staying in Australia?
I had pretty well thought I'd be traveling around the world with TD, and then eventually end up back in Canada. But I'd spent quite a few years working offshore with them, and Australia was just another posting. But after meeting my wife, and I have to say, enjoying Australia so much, and when I arrived, I interestingly, they arranged permanent residence visas for people like myself wherever we went, so that they didn't have to worry about us getting booted out. And so it was quite an easy thing for me to do when Westpac said, "Hey, would you like to come and work with us?" They were just at that time really expanding a lot of their corporate banking to be more international in nature, and having the experience I had, they thought I could help them, and I had a very enjoyable time with them as well.
For those people, Per, who aren't familiar with corporate banking, and I'm led to believe that you rose pretty highly in Westpac, up to be the head of the Asian business, if I'm not mistaken. What did your role entail towards the end of your time at Westpac?
Well, it's mostly dealing with large companies, and examples would be the Japanese trading companies. I'd worked in Tokyo for a while, and so you're really managing relationships, and it was just fascinating, because you deal with people here in Australia, obviously, but then also in the Asian business area, in Japan, elsewhere in Asia, and at that time things were really expanding for the Australian banks in the Asian area. So it was very, very interesting. They also, because I had spent a lot of time in property, were very big investors in Australian property. So you could kind of blend the two, both an experience in dealing with international business and Asian business in particular, and then dealing with property.
It's an interesting relationship, because there's so many appealing aspects about Australian property, which we'll get to in just a moment. But oftentimes it's only the negative things which hit the headlines. If I'm not mistaken, Per, you moved from Westpac, you moved on to AMP, and then eventually to Mirvac, and then Quadrant, I should say too. But that was after the GFC. Can you describe the market in Australia, I guess, in a lead up to the GFC, some of the lessons you learned there in the roles that you fulfilled?
Yeah, it's interesting, because of course what we're doing right now is looking at the environment and trying to pick things that perhaps are similar, and perhaps more importantly, things that are very different. And I might go back a little further to the early 1990s, and at that time I was working with Westpac, and you might recall the time. It was a very, very tough time for Westpac, and a lot of the issues had to do with property and property development, lending against developers, but very, very different than some of the issues that we're looking at today. Interest rates were sky high. And if there's one aspect of the economic environment that makes what we're facing today completely different in my mind, it could be just that. I was looking at what the cash rate was at in the early 90s for some research I was doing. And it's hard to believe, because, it's quite a while ago, that, 15%, up to 17% at one time, very briefly. And what would someone who had a commercial property that they had funded against debt and were paying interest rates like that, what would they do if the market fell out, the bottom fell out of it, and vacancies started to rise? Well, there wasn't much they could do at all. The market just collapsed. But the other really interesting thing was the one aspect or one sector that was doing very well was retail. And what's happened today? Well, boy, if there's one bunch of property types that are really struggling, it's retail, and particularly the big shopping centers. And yet back then, they were leading the way. So all sorts of different things that drive property, drive investment, and looking for those differences when we're comparing periods of stress, I think is a very important thing. And it's funny, you don't seem to see as much comment about that in the financial press as you might think. Every once in a while someone does, and there was one recent article I saw where they were particularly emphasizing that, but it doesn't come up too often, but it's worth considering.
How about then, I guess that seems there's some similarities but also some crucial differences there. How about during the GFC? I think that's, maybe it's just recency bias, I guess, maybe it's etched into people's memory a bit more. But how do you compare then to now?
Listen, we went pretty well during the GFC. And it was fairly temporary for us. And I thought that it was almost like more of a stock market driven event, which is so different from what we're dealing with now. I thought it was quite similar to my memory of 1987 and the stock market crash then, which occurred just as I arrived in Australia. But we found that we were able to work through the GFC in the property sector really very well. And different sort of demand issues, I guess, for different sectors of property, things that we're seeing now that don't really seem much like what it was back in 2008. So I'm thinking that as we get through the next little while and start to see some sustained recovery, that we'll be in pretty good shape here. Thank goodness, and I speak to my family overseas quite often. Thank goodness we all live in Australia. It just has dealt with this crisis so extraordinarily well, and I know that there's obviously all sorts of issues that come up between the premiers and who's locking down what border. But when you compare it to what we read about and see on the television in the United States, and even in my home of Canada, things are much worse there in terms of the number of cases. And we're really lucky here. It doesn't mean that you don't see that impact, though. I speak to a lot of our borrowers, and they're making good progress in their businesses picking up. But just as one gentleman I spoke to today was saying, things are just getting better, and then he happened to be in one of the suburbs in Melbourne that's been locked down. And he said, it's just going to, put me back another month and a half. And that's quite depressing. And I think, sentiment has a lot to do with it. If you can see the light at the end of the tunnel, you're going to be much more positive about how you're going to work through these issues. And if you start getting down about it and say, oh gosh, and there's going to be a second wave, and this is going to happen, and that's going to happen, it's pretty tough to keep going. But I find that most people are positive, and they're just thinking, give it a few more months, and we'll start to see things picking up again.
Okay, so one of the things that we should probably frame for our listeners here is, I guess, around about 2006 is when you took up a position, director, ThinkTank, the business, commercial property finance. People may have heard of it, and probably a lot of our listeners have heard of the business. But can you talk about the early days and, I guess, why the business came into existence and the opportunity that was there at the time, and maybe bring us up to speed to your role today.
Sure. Yeah, it was very, very exciting, and like I think a lot of business startups happens by chance. And at the time, you go back a little bit, just before that, AMP was going through some difficulties, and they were changing the business structure. And the business that I was running, they decided it was going to be better for them to sell that, get the capital back, and move on into different things. And myself and a couple of my key colleagues in the business thought that, wow, what an opportunity this might be for us to recreate this business. And what it basically was a commercial property finance operation that used brokers, third-party introducers, in much the same way that residential property was operating. And not many people did the commercial bit. We thought we did it pretty well, and it was a profitable business for AMP, so they weren't getting out of it because it wasn't making money for them. They just needed to look at their capital resources and how they could allocate that. The other thing we had done that attracted us to it was that we had done the first securitization of commercial property here in Australia through AMP. And again, my colleagues and I had worked closely on that. And we thought we could replicate that. And of course, what we had to find were some people to join us as investors and find a bank that was willing to provide the warehouse funding for it. And luckily, the connections that we had all had and the experience we had in corporate banking and the fact that we had actually done a securitization program for commercial property opened the doors to people who could assist us. And our third partner basically was a broker, a commercial broker, whom we got introduced to again just by someone else that we both knew, and it turned out to be a great experience coming together with these people, and we're all still here many years later, and still enjoy working with each other. And the business has actually, I think, in the last couple of years, has probably even outdone what we thought it might be able to.
That's fantastic. I think you can look back over some of the announcements that have come out of the business over the nearly 15 years now, and you can trace them, and you can see particular milestones through time. One of the really interesting points of our conversation, which we spoke off air about, is, I guess, the ability to serve both sides of the market. So you've got investors and you've got borrowers. Can you explain, maybe with an example, how the business works and how it fulfills the needs of both of those people? And then we'll tie that in, I guess, later on in the conversation with why this is an interesting asset class right now.
Yes, sure. I'll just deal with the structure first, which is probably the easiest way to introduce how investors can become involved, because it's quite different from the way that many individuals think of investing in property, and they can think of some historical stories that maybe aren't that pleasant and don't have great outcomes, but they also realize that within property there are very attractive returns. So the secret is, how do you capture those attractive returns and yet not expose yourself to some of the risks that we've seen that have damaged other investors and businesses. So the way that we structure the business, and then this all revolves around this securitization business that I mentioned earlier, is that funders, and initially it's the banks, lend us money within a particular trust, so a structure that's really closed, so that none of the security or the money can escape from the particular structure, and we use that money to lend to borrowers who provide us with first mortgage security against properties that meet certain criteria. And these are all held by a trustee in a particular structure, and the monies that flow in through repayments and interest, etc., all flow down what generally are called waterfalls, which probably is an apt description for them. So the money flows in and then gets distributed to all the lenders. And the lenders all sit at different levels of priority within these structures. So the people who are most secure, who are the senior debt providers who sit right at the top of the stack, they still get good margins, but they get the slimmest margins because they take the least risk. You then go down through this what's called a capital stack, and as you go down, you find different types of investors, investment companies that are willing to take a slightly higher risk for a slightly higher return. And within those type of levels, those parts of the capital stack, that's where you find individuals. Usually they're high net worth individuals, sophisticated investors who can understand what these structures are all about. And they're willing to invest because they can see that they are taking greater risk than if you put it in a bank account or bought a government bond. But I mean, these days you get 1% if you're lucky. And with these type of investments in property securitization structures, you get much higher returns, and we'd be talking, anywhere from say 5% for the a less risky type of investment to perhaps as high as 8% for something that carried more risk. And we're certainly not the only people who do that, but they're very, very interesting types of investments for individuals to look at. Would I say that it's the type of investment that your grandmother, who's never dealt with this type of an investment in property, or is knowledgeable about interest rates and returns? No, it's not for everyone. But people that have an interest in this and have that level of sophistication, it's very interesting because the level of returns are so low elsewhere that you really have to look at something else. You have to look at alternatives.
Yeah, one of the things that this kind of catchphrase that a lot of pundits have jumped on lately is this idea of TINA, and it's there is no alternative. And normally, what people think of when they hear that is there is no alternative to the stock market. So people think, bond yields are pretty low, interest rates are extremely low, dividends are still there for most companies. We'll see how they fare throughout the coronavirus, shock. But this is another aspect of, an asset class that people probably don't, at least in my experience, probably don't pay enough attention to. Maybe because they don't understand it, or maybe they just don't know, they're just not aware of it. I think you put out a piece recently where you talked about the allocations in most self-managed super funds, for example.
Yes.
Are predominantly to listed shares and cash, and pretty much everything else is dwarfed by that. But yet this is probably one of those instances where TINA applies, and if people still have that longer term time horizon and these sophisticated investors or SMSFs, etc., are looking around thinking, what are the opportunities for me? Maybe the SMSF's thinking, I want to borrow money because I want to invest in something. or just get exposure to these types of returns, I think this is the time that a lot of these companies these people are thinking about it.
Yes, it's your mention of the asset allocation within SMSFs is very interesting, and we have a special interest in SMSFs because we lend to them to invest in property, and not a lot of other people do that. And there's a level of knowledge that you have to be able to do that, both at the borrower's level and the advisors, of course, that are dealing with them, and as a lender. But the point that you were making, when you look at the statistics that the regulator of SMSFs, the Australian Tax Office, puts out, it's quite amazing at how much is just cash and term deposits in a period when we're dealing with record low interest rates. It doesn't change much. It's not as if people all of a sudden, as the rates were coming down, said, "Oh, we better get out of that and do something else." And then next to that, at about the same level, are equities. And you can understand that because I think when we look at the statistics, if we take the banks, for instance, the listed banks, the majors, they're really favorites of the SMSFs because they were paying very good levels of dividends. They were fully franked. The franking credits, thank goodness for them, had lasted through the last election, and efforts by some to get rid of them. But they provided a very good return. But then what happens when all of a sudden there is a crisis, and most of the banks canceled their dividends this last financial period? They're saying, they may reconsider that in another 3 months, August, September, but it's devastating for retirees and SMSFs who've depended on those. And so the whole idea of diversification, I think, is what comes up when you start thinking about that. So sure, you should have some amount of cash, you should have some amount of safe bond-type investments, but you also should look at other higher-yielding assets and consider, if you feel comfortable with them and if you have the knowledge to be able to deal with them, that's something that has a place in the asset allocation of something like an SMSF, or the SMSF is really, a tax structure. So it can just as easily be your family trust and or some other investment vehicle, and you just decide, well, I've got this $100 to invest. How am I going to split that up? And taking a look at something like property, obviously, and at some sorts of property investments, property debt investments, such as we offer, it's worthwhile doing.
When people, like you said before, when people think about this, they often recall kind of the negative instances where there's certain investors have faced pretty severe capital loss. And as we now go through coronavirus and the shock that comes with that, both in financial markets, but also, in just walking down the street, you can see that many of these retail outlets are out of business or just completely not functional. How do you think about risk management, both as a lender and as an investor?
Yeah, well, two pretty key issues, I think, for the investor to look at is within the structure that they're investing. And again, we'll use the same word. What sort of diversification do you have? So, are you lending to maybe just a couple of different borrowers with maybe 3-4 properties as the security? Or are you dealing with literally hundreds of borrowers with hundreds of securities? And what that does is it minimizes the risk that they're all going to have a problem at the same time. It's just pure mathematics. The other thing that you need to look at is, what's the track record of the people who are managing those investments? And it's one of the reasons why when you first start out, it's hard to attract a lot of investors. You know, the first day you open the door and put the shingle up, people, they don't know you. They say, what have you done? You can talk about your history, and unless they've dealt with you before, it's pretty hard for them to say, well, I'm going to put, you know, some of my retirement savings in your hands because you've got a good story. What they want to see is track record. And we think that ourselves and other people who do the same sort of business really try and emphasize that. So they try and get across to the potential investors and the advisors that this is what we do, this is how we do it, and we've done it for a number of years, and this is the track record that we have.
So when you look back over ThinkTank's, I guess, track record and history, I saw on the website that it's pretty impressive in terms of, I guess, the absolute return and the absolute risk that investors have faced in either of the funds over a very long period of time. Can you care to mention how from an investment perspective and how the allocations within the capital stack and I guess how you think about that and how that's reflected in that downside?
Yeah, it's one of the beauties of it is that investors in our private funds are really taking the same risk that we take and other corporate and institutional investors take in our whole portfolio. So it's not as if we identify, you know, just a couple of loans that you'll invest in. You really get the safety and protection of the hundreds, thousands of loans that we have out there. So it's kind of a shared risk. And yes, the money goes into a particular loan, but those are all within those trusts that I was speaking of. So there's protection that you get from that. And the other side of it is that you can look at the track record and say, okay, so over the years, how many losses have you suffered? What percentage of losses? And because we only make relatively small loans, we don't make any loans over $3 million, the impact is not that great if you have a problem. And it's just easier to recover that amount of money than if you had to sell, you know, $100 million office building, and the market was weak. That's a tough call. If you're dealing with a smaller industrial property, there's much more demand for it. There are many, many more potential buyers, and so the type of problems that you would always face with lending. The lender who tells you they have no arrears, they have no problems to address and work out, is not telling you the truth, because it's the nature of the business. It's how you manage them and what the outcome of those issues are. And for us, I have to say, some of it is you'd say, well, also good fortune, because the markets have been good in property. Minimal losses over the period of time that we've been in business, and all of those statistics and all of that background is provided to investors so they can have a very clear picture of what we've been doing and what the results have been.
You see, one of the things that I think about is, and I'm definitely not the first one, so this is not an original thought, but you know, one of the things I think about is, particularly on some of the big bond funds, investing in govies or anything like that, the duration and the risk around that is substantial right now because interest rates are so low, right? So if you think about a traditionally safe, uncorrelated asset class for the most part, now in portfolios alongside shares or equities, you now have, I guess, substantial potential for volatility and risk there But if you're willing to hold to maturity, you're still not getting, I guess, a great reward for the risk that you're taking. Whereas if we look a little bit further down, I guess the curve and a bit further out in the risk curve, I should say, we're looking at different asset classes, and this is where I guess commercial real estate debt comes into a lot of people's thinking, because the returns are probably asymmetric especially when you put them alongside traditional bond markets. One thing I'm interested to understand more about is if someone invests to get exposure to commercial real estate debt, what are they actually getting typically? And the reason why I ask this is because I believe that you've structured it a little bit differently insofar as normally we'd invest in a managed fund, you get units, you get distributions, etc. But I think you went a bit differently.
Yes, it's really an investment that you make in the trust as an individual or a trust or an SMSF. And it's an obligation that the trust has to you, but it's not tradable in terms of selling it off to someone else. You literally you should have a longer term perspective, because it's not something that you're going to put in 1 month and take out the next. We try and accommodate people if there are liquidity issues, which arise in life, but typically you really are making a commitment to leave those monies in the fund for a period of time, probably up to at least a year. But as I say, when matters arise that something changes, if we can accommodate, we do, and usually we've been able to. It's a little bit different, and that's why it's really worthwhile reading the information memorandum that's supplied to prospective investors. I mean, I know sometimes people get, you and I are interested in this sort of stuff, but not everybody is, and there's a certain amount of information that we're obliged to provide. But it's also really in the interest of the investor to review it. Take some time, sit down, make sure that you're comfortable with what's being described, what the history that I've been talking about is in the company, and what the performance has been. And then at the end of it, you either say, yes, I'm comfortable putting some money in it. I would never recommend to any investor that they put all their money in any particular type of asset. I think that's just diversification is your friend as an investor. But once you're comfortable and you sit down, and whether it's with your partner or maybe it's just you, and you think about it, you say, yep, I'm comfortable making that sort of investment. That's when it's good to then take the next step. But to just rush into it and throw everything at it because the yield looks good, which quite possibly is the case today, and that's sometimes what happens with equities. People say, "Oh my gosh, this stock has gone up 50%. Oh, I better get into that." Well, yeah, it might go down 50% in the next couple of months too. So you want to be comfortable that you really understand the risk that you're taking.
Yeah, Per, it's one of those things where I guess you would maybe think of probably equities to commercial real estate debt is probably not a great comparison, because it's not necessarily apples to apples, or even they're probably not even both fruit to keep going with that.
Yep.
But the thing about it is that there's people out there probably thinking, like I was quite a few months ago, my options are really maybe hybrids, maybe term deposits if I'm being a bit more conservative. But even hybrids can be quite complicated, right? So you say read the IM, but even there's in it if you have the side by side, you'll be looking at a hybrid information document, and most people will probably be bamboozled by that or just not read it because it's way too long.
Yes, yes, but that's a big issue. It's funny you should mention it, because we try to be quite aware of that. Now, how do we get the information across to people, the information that we need to get across, but how do we keep it at a manageable length so that someone isn't faced with reading, a 60-page IN? They won't do it. Most people just won't do it.
And it's like you said, it's important, right? And I think recent experience with a lot of people who had, for example, bank stocks for the dividends and then hybrids for the yield there are discovering now that those two things are probably too much the same. But my point was more so around, I guess, when you think about it as an asset class and something to allocate to, and it's not something that we talk about enough on the show because we normally talk about equities, right? Because it's a bit sexier and it's a bit, everyone loves stocks and ideas and that type of thing. But this is a very important part of a portfolio. You would probably be thinking of those two things at least side by side when I'm looking at building a portfolio, for example. How do you think about, I guess, this exposure, more broad strokes than sitting in a diverse portfolio? The ATO mentioned 6%. Do you think that's too low?
Oh, I do, but I do also understand that it's for the people that we deal with, getting into direct property in SMSFs is a big step, because almost inevitably, and the ATO has brought this up quite frequently, and in fact they brought it up very strongly, that you are really giving up some of the protection that diversification provides you when you invest in direct property, because there's just a certain dollar amount that it makes up the value of any sort of property, even if it's the smallest residential unit you could find. It's still going to be hundreds of thousands of dollars, and for many people, their superannuation savings, they're not in the millions. They're much less than that. So you get a very high concentration of the asset in that. One of the ways that people get around that is and it can assist, is by borrowing through limited recourse borrowing arrangements. But the tax office and regulators have been, and I understand why, they've been against it. They've spoken often about why they think that's not a good idea, because they think that it adds tremendously to the risk that people's superannuation savings are subjected to. I have to say, in my experience and the analysis that you can subject that to, that's not the real outcome. The SMSFs that borrow money tend to do so very conservatively. They're very aware that they're putting their superannuation savings at risk, and the outcome of what they do in no way has subjected the industry or the system to what's described as a systemic risk, and they've admitted that after looking at that quite closely. But they're still not completely sold. I don't think. We haven't heard much about it because they've had other things to think about. But my guess is that that sort of a question will come up again. I think for the right type of investor, direct property in your superannuation fund, in your SMSF, is an outstanding investment. Now, I'll just give you a quick example of where we see people benefiting the most. And that's people who run their own business, who use their superannuation fund and often borrowings within the SMSF to buy their own business premises. And there are special rules that allow them to do this within the Superannuation Industry Savings Supervision Act. And it's it just makes so much sense in terms of, instead of paying rent to a third party for their business premises, they're paying rent to themselves in a superannuation fund, and it's their livelihood, it's their business, and it's a tremendous way to benefit from it. And I would say about 50% of the people that we deal with would fit that sort of a description, and they have been very, very successful with them.
It's definitely something that, if I put on a financial planning cap, you talk about a lot, right? You see it particularly, like you said, with people with businesses, obviously, but you see it as they transition as well, in that around crucial stages in their life, and how that
absolutely.
plays a role there too. It's definitely one of those ones where you could probably commit an entire podcast series just to talking about the nuances in it. But it's certainly something that I think if people aren't aware of, they should be. Purely from
and as you say, the education side of it is important, because most of the people that we get introduced to us have learned of this through a financial advisor, and many of them have been referred to those financial advisors by their accountants, because their accountants understand their tax position, they understand how their business is operating, and while accountants can't provide the full range of financial advice because of the licensing restrictions, they can introduce you to financial advisors, and it's so well worthwhile looking at these sorts of alternatives.
For sure. Per, I think it'd be remiss of me, as we come towards the back end of the conversation, I think it'd be remiss of me not to ask you how you think, I know you've got a bit of this in the latest monthlies, but how you think about COVID's impact on the retail, office space, property at large. How long do you, if you could stare into your crystal ball, how long you think, property investors, if they will be impacted by this, how long, and kind of what are the outcomes for investors in the market right now?
Yes, yeah, it's very interesting, isn't it? And you mentioned the retail in particular. I think that, and we have been thinking, and we've written about this a number of times over the past literally few years, that retail was kind of a growing risk in our view, and it seems that the COVID-19 crisis has just been the trigger to bring all of these issues which have been arising right to a head, and the hit to consumer confidence, the issues where people just are not going to shopping centers. They don't want to go out and shop. They're going to buy over the internet, and it's been almost an overnight issue that's arisen, and you can read in the newspaper just about every day of some retail outlet that's either someone who is in selling a product that goes through the retail mechanism that they're going under, or a landlord, an owner of these shopping centers, who's written down the value of the property, cutting their distributions. It's been quite a list over the last couple of months of the real estate investment trusts that have been in that position. So retail, to me, is one that's a real standout as having been impacted in such a way that it's not just all going to change back to what it was. This impact is a lasting impact, and we're really going to have to adjust to it. The other area that I've mentioned a couple of times is, and again, something that has kind of been brought on by the crisis, was the development of off the plan units particularly in the big cities, Melbourne and Sydney. And I'd long been concerned that there could very easily be an oversupply, and that we'd start to see the impact on the prices of these units once they are completed and settled, compared to what the contract was when it was sold off the plan. And we're starting to see that sort of thing now. And one of the things that I hadn't really factored into my concerns was migration. And we're seeing many more articles now about what sort of impact the reduction in migration that is surely going to take place is going to have on things like apartments in the inner city. And I think that will be one to watch as well. The other, working from home, just our experience here in our own business, but it would be replicated in thousands and thousands of others, is that people are very comfortable working from home. And I think businesses, and we as business operators, are more and more comfortable with our employees working from home. Sure, we like to see them in the office every once in a while just because we like to see them. But with technology, we've made, and others have just made, leaps and bounds over the last 3 months. We've probably done things that would have taken us 3 years to do in 3 months. And I'm sure you've had the same sort of experience. And it's quite instructive. I don't think it's going to be a disaster for offices. I think it may office space in the big cities. Vacancy rates have been very, very low. Rents have been going up, and that will moderate. I don't think it's going to be a disaster at all, but that will moderate. The area that we're very active in is the smaller industrial, and that is standing up very well. Again, part of it is diversification because there's a lot of it, but demand for distribution centers, which often exist alongside of industrial estates, is adding to the value of those areas. So it will be very interesting, though, to see how professional valuers deal with all this. Right now, it's pretty up in the air. How do they factor in these sorts of risks into the valuations that they provide to investors and purchasers? There are pages and pages of disclaimers in any valuation you'd look at today. But as you can imagine, it's changing. It will change. People will get comfortable with what's happening, and probably one of the biggest factors in terms of valuing property are capitalization rates. So what's an acceptable yield for a property? What sort of income do you have to earn from it? And of course, with the cash rate at 0.25%, government bonds being controlled to be about the same for 3-year bonds, and then 1% for 10-year bonds, you can't expect these capitalization rates to go very high. They have gone up, but you wouldn't expect them to go much further. So the values are on things like those industrial properties are probably pretty secure.
Yeah, I think for most people, most listeners will be familiar with capitalization rates and how they impact valuations, and I guess the incentives that come and need to be factored in there too. It's a really interesting conversation. It's probably one that we could talk to for quite a while.
Yes, like most of the other things we've spoken about today.
Yeah, but so why don't I kind of wrap it up around there, Per? And what I'll say is I've got 2 final things. Just how can people get in touch with you and ThinkTank? What's the best resource for them to learn more about this?
Yes, well, there is quite a bit on our website, which is just ThinkTank Commercial Finance, and you'll get taken right away to it's quite a large website because we cater to all of the brokers, the finance brokers who introduce business to us. But there also is a special section for investors. So you can access that, and you can have direct access to a colleague of mine, Lauren Ryan, who handles personally investors who are interested in ThinkTank, and you'll get excellent attention from her. And there's a lot of material that you can read as well. And some of it is just opinion that we write in terms of providing research on property and the markets, and other is information memorandum that has facts about the background of our business, such as I was talking about, and that I'd suggest you take a look at.
And I'll put all those links in the show notes. I think it's a sector that people should know more about. Even myself, I probably don't appreciate it enough. I spend so much time looking at individual businesses and stocks and what have you. But I'm just so happy that you could come on the show and give us this introduction to the sector and to kind of the business you've built and how it kind of serves both parties. One final question for you, Per, one that I always ask is more of a philosophical one, I guess. If you could go back and tell yourself one thing about money or investing, what would it be?
Wow. It's it's a bit the same. It's diversification. I can think and you'd think I would have learned this in 1987. I was overweight with listed equities. Mm-hmm. And in 2008, I was overweight in listed equities. So, in the 21 years, I guess, perhaps what had happened was that I had forgotten about it, because one of the things that does happen when there are these sorts of negative turns in markets, very often there's a good recovery that follows, and then you start to forget some of the pain that you might have experienced previously.
Yeah, indeed. So I like that fitting end to this conversation, Per. Thanks for your time today.
My pleasure. Thank you.